Anurag, hi, morning. Great to have you on the show. And tell us more. Seems like now volumes and queues are all going to dry up for global markets as we step closer to the December break. What do markets look out for?
Yeah, so Aisha, markets are, I mean, there are no signs of trouble as such for the US market, right? Now, I mean, projections vary from 7,000 to 7,400 by the end of 2026, next year, right? So, which means that market expects that there's not a significant upside, at least on the index level. But at the same time, the real action lies beneath the index, right? And there is a reason why I'm making this projection. One is this whole AI trade is now beginning to falter a bit, which is that people are beginning to question whether this investments into data center are going to give the ROI that the markets are projecting, at least not at the pace at which it is projecting. And we saw that very clearly reflecting in the Oracle stock, who had which had projected almost like from zero revenues today to almost like 125 billion by 2030. And that's also little bit delayed. So stock saw a 50% correction, believe it or not. Broadcom saw nearly about 35-40% correction. Nvidia is 15% down. So I think it's a very healthy skepticism, which is fine. We don't want to get into a bubble. But outside of that, economy is running very hot and at a very nice pace. And I say this why? Because we look at tariffs, but I think look at how beautifully the other two pillars of the Trump administration are working out. One is taxes, low taxes. So that is already, the bills have already been cleared early this year. And the next is deregulation, and the market is really looking forward to how free market ideally should perform, in an economy like US. So overall, no signs of trouble. Markets are looking fine. AI trade might have peaked out at least in the short term, but there's no imminent danger in terms of, there might be some air pockets here and there, but overall market is pretty stable, robust, and GDP is still growing at 3%. So what more could you ask for?
Anurag, India was considered as an anti-AI trade, and that's one of the reasons why IT was underperforming. Now that you yourself is saying that the AI trade in the US is faltering, do you see money going into Indian IT services company?
So at some point, I think they should become attractive, right? My question is, look, we are in a world where people are saying, is Google good at a price earning multiple of 30? Is Apple fine at a P multiple of 30? Microsoft is 32, Meta is 25. When those are the questions being raised, there is always going to be a question about how much these IT services should be worth. Should they be above 30 price earning multiple? I seriously doubt that, right? So they might get more business going into next year, but I really question the multiples that market has been according them over the past 2-3 years, right? I mean, I know TCS hit almost like more than 40 PE, right? That's not warranted, right? So I am sure that these companies will grow at a stable 4 to 5% top line. But they have this existential threat constantly on their head, which means that their multiple should also correct to kind of 20 or something closer to that number. But that's an outsider view, right? Indian markets have capital control, so market might decide to rate them a little higher. So that's my kind of high level view on this.
And Anurag, just switching back to AI, right? You suggested that some stocks have corrected, some 5, some 30. Good time to buy the dip, you reckon?
Which ones?
Some of the AI counters. You suggested that we've seen a bit of a correction. Caution is good, is what you spoke about.
Okay.
Could this be a
Yeah.
great time to buy the
Yeah.
dip?
Yes. So look, let's divide this into hyperscalers and everybody else. I'm skeptical on Nvidia, at least at these levels, and maybe a little, I've been skeptical ever since kind of it was at 100, 110, 120, right? It was like 1,000, 1,200, then it got split. I think that skepticism continues because after all, it's a hardware company, and the moment it is just one innovation away from a disaster, right? I doubt whether it can continue to maintain a 75% gross margin monopoly, right? That's huge, right? Unprecedented. But outside of that, I think I'm pretty optimistic on these Googles of the world and Metas of the world and Amazons because uh, they are deploying artificial intelligence. And look what happened. We were questioning where will this investment be, where is the ROI? Microsoft has increased the corporate licensing prices by 30%, just like that. And there is no alternative to that. Even I'm paying that 30% price rise. So they gave me the kind of autopilot, once to try out, and then they said now we'll be charging for it. So I think you can buy the dip in. To answer your question, you can buy the dip in the companies where the revenues are steady and stable. So in case of a trouble, they will just slow down their investments, but they are still rich on cash flow, which is the companies I'm talking about. But companies like Nvidia, Oracle, some of the others, they are not sitting on huge cash flows, right? So much of that lies in the future. They are more in trouble, right? Including OpenAI, right? Which claims that it is kind of 500 billion just on a revenue of 15 billion. So that's a bit of a broad take, but I think I'm pretty comfortable on some of these other counters, which are reasonably valued, I would say.
And Anurag, if I were to shift focus to India, you like large caps, and you continue to be bullish on them. But talk to us about mid and small. How much of a correction needed? And I'm talking just broadly. I'm sure that there'll be certain sectors, pockets which will require a larger correction for you to get comfortable. What is it that's keeping you away from that pack, and how much of a correction would you reckon would get you interested?
So my whole point of staying away was that the entire, the 493, outside of mega cap 7, the entire rest of the 493 was so appropriately priced or underpriced that there was too much of bargain going around in the US market. Some of that has panned out, especially banking over the last 1 year. But outside of that, mid caps, small caps, immense value. In India, right or wrong, here is my thesis. From 1994 till 2019, the Nifty had a returns of 12%, the entire period from 1994 to 2019. But mid and Nifty 500 had returns of 11%, which tells us what? That the entire gamut of the rest of the 400 stocks, actually 450, performed poorly than the Nifty 50. Effectively, I think we are getting back to the point. If you look at from 2020 till 2026, so 6-year return, Nifty is around 13% now. Mid and small both were around 30% till last year. Now that CAGR looks like more like 22%. So I think there is more moderation to go. Ultimately, mean reversion is the ultimate truth in the market. I don't think anything has changed outside of that. So I expect more correction to follow in mid and small cap. And I've always been a big fan of large cap in India. But that, I might be skeptical because my allocation to India would be expecting a 10-12% stable return, which I largely get in large cap. Otherwise, you to find hidden gems for which you locally have to be in the market. For me, that natural market is United States. That's not India for me. So that's kind of my where my skepticism comes from.
And I guess that explains the kind of flows that we've had here to date. But Anurag, great chatting with you. Thank you for your time as always.